Hello and good day. This is episode 4 of the series How to Avoid the Most Common and Costly Mortgage Mistakes. I'm Jed Wonderly with Noble Home Loans, and this episode we're going to kind of follow up a little bit on what we talked about last episode with regard to investing and investing principles and why you shouldn't put a maximum down payment down. You know, I told you I've had clients that have had $150,000 to put down on a $300,000 house because they wanted the lowest mortgage payment possible, things like that. And what that speaks to is their lack of knowledge or good information that they have with regard to the kind of wealth creation that they're going to miss out on if they put that whole $150,000 down onto the house and convert that liquid asset into an illiquid asset. Not only do they do that, but then they also have the opportunity cost of not being able to invest a big chunk of that money in other things that are going to be able to grow their money a lot over time. We talked about the rule of 72. You can see my episode 3 where we talked a lot about that. Also the time value of money and how important it is to get money working for you sooner rather than later. We talked about doubling periods in that episode 3. The other thing that happens is you miss out on tax advantages. So you know that should never be the main reason why you choose to do a mortgage a certain way is because of tax advantages, but it's certainly a nice secondary reason. Another thing to think about, and I may have touched upon this, is that if you take that money that you don't put down, for instance, that $150,000 on a $300,000 home, really they only need to put down $60,000 in order to avoid mortgage insurance, because that's 20%. They could take that other $90,000 and invest it, and what that does is they could get there's a couple of things. First of all, they could get income from that investment to help with the higher mortgage payment. And another way to think about that is that if they were going to invest anyway, let's say they were going to fully fund their Roth IRA for a husband and wife, that would be about $916 a month they would need to save in order to invest $11,000 per year, which is the maximum that you can invest in Roth IRAs before you turn 50. It's $6,500 a piece after you turn 50 for $13,000, so a little over $1,000 a month if you're over 50. So, you know, if you're thinking of doing that anyway, then think of that as part of your payment. You know, roughly $1,000 a month for investing plus your mortgage payment. So if your mortgage payment's say $1,500, and I'm just throwing out a number, and you've got $1,000 going into investments, then you've got $2,500 in total payment. Well, if your mortgage payment is $2,500 because you've kept out $90,000, and again I'm just throwing out numbers, then that gives you, and it probably won't be that much more just for an extra $90,000, just so you know, but I'm just trying to help you understand how you could think about justifying keeping that money out and getting it to work for you, and that doesn't even talk about the great benefits that you'll get in terms of the wealth creation down the road. Now, what I want to focus on in this episode is a little bit more of the same, but I want to touch on leveraging and investing in real estate, and why, again, you shouldn't put a maximum down payment down. If we take that same scenario, $300,000, and we say, let's say that the market's appreciating at 4%. Well, if you buy a $300,000 home and the market appreciates at 4%, then that $300,000 home is now $312,000 1 year from now. Your investment is $150,000 if you put the whole thing down, and so you get a $12,000 appreciation amount. You've got basically an 8% return on your money. Now, if you only put down the minimum of $60,000 so that you don't have mortgage insurance, and you would need to put down $60,000 if you were buying this as an investment property, but if you put down $60,000, now your investment's $60,000, and this is where leverage comes in. For a $60,000 investment, you still get that same $12,000 return. Now, your return is 20% and not 8%. Much better return. This doesn't even speak to the possibilities that if you're buying a home as an investment property, the rental income that you're going to get. And if you're buying it as an investment property, there's also more tax write-offs than if you were buying it as a as a single family home as a primary residence. So I would definitely say that, you know, it's very important to know your numbers. I've put together spreadsheets about real estate investing as well as investing in general, and with those numbers and the proper information, it'll help you to really structure your mortgage appropriately in terms of achieving your financial goals and the kind of retirement that you're looking forward to having, so that you're not working, you know, full-time, you know, at a job that you may be laid off for once you get past a certain age, just because you can't perform your duties as good as, you know, somebody younger. But having that kind of information and knowledge is definitely power. And I'll leave you with this. I work with a lot of different types of financial professionals, and some of them have some great investments. You know, like for instance, I don't want to call it hard money lending, but in a sense that's what people might think of it as, where you could take a chunk of that money and instead of putting it down on your house, you can invest it into mortgage notes. And by doing that, you could get a nice return, 10 to 12% on your money. It's safe because the LTV is typically around 50%, so you have a big cushion, and we're not likely to fall, you know, and lose a lot of value, especially where we're on the recovery path. So again, with a safe return and something that's secured by real estate and gives you 12% return, you can take that $90,000, and at 12%, that's going to give you a nice annual income. And of course you can reinvest that to grow your money even more. But you know, that's just one of the many types of choices you'll be able to make if you don't, again, put that liquid asset and dump it all into your house, which is an illiquid asset, and actually reduce the amount of wealth that you can create over time. There's a lot more we can talk about, and I'd be happy to talk about your specific situation with you and show you your numbers if you'd like. Again, my name is Jed Wonderly with Noble Home Loans. I'd also love to, you know, refer you to some of my financial professionals. You can talk to all of them and see which one you would work with best. They're all great. Also, it's important to have an estate plan set up for a whole lot of different reasons, and we've got some great estate planning attorneys that I work with. And again, it just helps to know and understand the principles of why you should do these things so that you can protect your assets, avoid probate, and a whole bunch of things like that. I'm Jed Wonderly with Noble Home Loans. Signing off of episode 4. Please like, comment, and share. And call me if I can help you with any of these and get you to understand your specific numbers. My number is 702-812-1214. That's 702-812-1214. Look forward to talking to you. Again, please like, comment, share, and subscribe so that you can get the next videos. And check out my previous videos, especially episode 3, that talks a lot about time value of money and rule of 72 and how much wealth you can create by structuring your mortgage the right way. Take care and have a great day. Bye-bye.